Welcome to the Explainer. So, when you look at a stock, see a completely sky-high price tag, and just immediately assume, yep, that's way overvalued? Well, today we're unpacking a really fascinating financial mystery. It's surrounding Construction Partners, Inc., which trades under the ticker ROAD. I'm honestly super excited to guide you through this data today because we're looking at what I like to call the road paradox. We're going to use the numbers directly from their latest performance metrics to answer one massive question. How exactly can a stock with a seemingly huge price tag actually be hiding some seriously deep underlying value? Let's dive right in. Just take a look at that single number right there, 103.26%. That is Road's completely staggering yearly return for 2024. Literally, in a single year, the stock more than doubled its value. And keep in mind, this isn't some tiny hyper-volatile tech startup. No, this is a massive civil infrastructure company. We're talking about laying down asphalt and building highways. When an established, heavy industry company rockets upward this fast, it absolutely demands our focus. You've got to ask yourself, are they just riding a speculative bubble, or is something fundamentally explosive happening under the hood? To figure that out, here is our roadmap for the Explainer. First, we'll look at Road's surging market performance. Second, we're unpacking the growth engine. Third, we'll dive into margins and financial health. And finally, the valuation. Is it overpriced or undervalued?
All right, let's kick things off with Section 1, Road's surging market performance.
This timeline really illustrates the wild momentum shift this company has experienced. Back in 2022, Road actually saw a negative return of 9.25%. Honestly, if you were looking at it back then, you probably would have just walked away, right? But check out what happens next. In 2023, it bounces back with a solid 63% gain. And then, bam, 2024 hits, and it surges an astonishing 103%. When you compound those numbers over a 3-year period, we are looking at a cumulative total return of just over 392%. I mean, that is a near 400% explosion in just 36 months. So let's bring all that historical hype right into the present day. As of the data we're reviewing, Road sits at a current share price of $126.53. That gives it a massive market capitalization of $7.15 billion. Now, the big question we have to ask ourselves here is, can a $7 billion infrastructure company actually sustain a near 400% per-year momentum? Well, to answer that, we're going to have to peel back the layers of their income statement.
Which brings us to Section 2, Unpacking the Growth Engine.
Contrasting the top line with the bottom line here reveals a whole lot. Just look at the top row for a second, revenue. The compound annual growth rate, or CAGR, over 5 years is a super steady 30.7%. Over 3 years, it's 31%. And for the trailing 12 months, or TTM, it jumps up to almost 54%. Honestly, that is fantastic top-line growth. But now drop your eyes to the net income row. While revenue grew consistently around that 30% mark historically, net income has just wildly accelerated. A 23% growth rate over 5 years morphed into almost 90% over 3 years. And over the last 12 months, net income growth hit an insane 118.59%. So they aren't just making more money, they're actually keeping a significantly higher percentage of it.
Now, if you thought that net income growth was impressive, you have got to see what this means for the individual shareholder. This right here is the earnings per share, or EPS, growth. The 5-year average is a very respectful 14.96%, but look at that final bar on the right. For the trailing 12 months, Road's EPS compound annual growth rate is an absolutely unbelievable 643.51%. That growth engine hasn't just hit maximum overdrive, it's basically strapped on booster rockets at this point. When a company's earnings per share grows by over 600% in a 12-month window, it completely rewrites the rulebook on how that stock should be priced.
Moving right along to Section 3, Margins and Financial Health.
Okay, so here we see exactly how that massive EPS explosion happened. It's all being driven by some incredibly rapid operational improvements. Their net profit margin is currently at 3.25%. Now that might sound kind of small depending on what industries you're used to, but that is actually up 32% compared to their own 3-year average. Then you've got gross profit margin sitting at 14.99%, which is up 17% from its historical norm. Return on equity is at 12.59%, climbing almost 38% against that 3-year average. And finally, return on invested capital, or ROIC, is up 33%. So what's the takeaway here? Every single major profitability metric is rapidly outpacing historical averages. They are literally just becoming fundamentally more efficient across the board.
But we've got to look at the whole picture here.
neutrally balancing the strengths with the potential vulnerabilities. This comparison lays it out pretty clearly. Over on the left, Road has very solid short-term liquidity. A quick ratio of 1.26 and a current ratio of 1.59 basically means they have more than enough cash and liquid assets to cover their immediate short-term bills. But check out the right side. We're seeing elevated leverage. The debt-to-equity ratio sits at 1.80, and crucially, that's up over 52% compared to their 3-year average. So to actually fund all this incredible growth and expansion, they've taken on a noticeably heavier debt load. It's your classic corporate balancing act. High growth fueled by higher leverage. Because as it turns out, paving highways across the country is surprisingly expensive.
And that brings us to our final section. Number 4, valuation. Is it overpriced or undervalued?
All right, let's start with the most common valuation metric out there, the PE ratio, or price-to-earnings ratio. Simply put, this measures the current share price relative to its per-share earnings. Now, Road's current PE is 57.51. In traditional value investing circles, a multiple of 57 usually makes a stock look incredibly expensive right off the bat. It implies investors are willing to pay $57 today for every $1 of current earnings. For a gritty, industrial construction company, that traditionally sets off some major alarm bells.
But wait, the historical context shifts this narrative completely. When we place that seemingly high 57.51 PE next to its own history, you'll see Road's 3-year average PE is actually 62.12. Its trailing 12-month average is even higher at 66.65. So yes, a 57 PE is objectively high if you're looking at the broader market. But for Road, it's actually trading at a discount compared to what the market has willingly paid for it over the last 3 years.
But guys, the real secret to the Rhoda paradox is right here, 0.53. This is the PEG ratio, which stands for price/earnings to growth. It takes that high PE ratio and divides it by the company's actual earnings growth rate. Generally speaking, a PEG ratio of 1.0 is considered perfectly fair value. Anything below 1.0 suggests a stock is undervalued relative to its growth. Because ROAD's earnings growth has been so remarkably high, remember that wild 643% EPS spike we looked at earlier, it compresses the PEG ratio all the way down to an astonishingly low 0.53. When you factor in the sheer velocity of their growth engine, this supposedly expensive stock actually starts to look really, really cheap. And we see this stark contrast when comparing the current trading price with the discounted cash flow, or DCF, fair value calculation. A DCF model basically projects all the future free cash flows of a company and discounts them back to what they'd be worth today. The current stock price sits at $126.53. But based on the massive cash flows this company is generating right now, the DCF fair value calculates out to a towering $194.21. This fully exposes our central paradox. A stock that has already skyrocketed nearly 400% might still be massively underpriced based on its actual cash generation.
Let's visualize that gap just to really hammer this concept home. This donut chart represents the full intrinsic value of Road, based on that discounted cash flow we just talked about. The current price only accounts for about 65% of its true calculated value, and that remaining 34.85%, well, that is your margin of safety. It acts as a fundamental cushion. It makes it crystal clear how a high PE stock can still offer really deep value to investors. The company's underlying cash flow growth is simply outpacing the already massive stock price gains. It's incredible.
So we arrive at the final question to ponder. With a nearly 35% margin of safety sitting right next to a PE ratio of over 50, everything hinges on one thing. Is Road's incredible growth engine actually sustainable? Look, if they can manage their elevated debt and maintain those expanding profit margins, the data suggests there is still massive intrinsic value waiting to be unlocked. But actually scratch that, if that 600% earnings growth slows down even a little bit, that high PE multiple could become very heavy, very fast. I want you to take these numbers, think critically about the path forward for this infrastructure giant, and see exactly how it fits into your own analysis. Thanks so much for joining me today on this explainer, and as always, keep learning.